Welcome to The Explainer. If you're a tax professional or a student getting to grips with the new Income Tax Act of 2025, you know that the real challenge is always in the details. Well, today, we are tackling a really high-stakes section that you'll definitely want to get right.
We're diving deep into Section 54. This is the section that lays out the very unique tax rules for the business of mineral oil prospecting and production. Now, this is a super critical provision in a massively capital-intensive industry, so let's jump right in. So, I want you to imagine this scenario. A company pours crores and crores of rupees into exploring a potential oil block. They drill, they search, and they come up with absolutely nothing. They have to surrender the area. So, from a tax point of view, is all that money just gone? Is it a complete loss? Well, as we're about to see, Section 54 gives a pretty interesting answer to that question.
Okay, so here's our game plan for today. We'll start with a bit of background. Then, we'll decode the core provision itself, explore the really powerful deductions it offers, and then see how it all works with a practical example. Finally, we'll cover the essential compliance side of things and wrap it all up with the key takeaways.
All right, first things first, let's set the stage. A provision like this doesn't just appear out of nowhere. And for any professional who's moving from the old act to this new one, understanding where it came from is really key.
So, take a look at this. There's a really clear line of continuity here. Section 54 in the new 2025 Act is the direct descendant of Section 42 from the old 1961 Act. You'll notice the wording's a bit more streamlined now, but the basic framework? It's the same. And honestly, that's great news for all of us practitioners, because it means your existing knowledge of Section 42 gives you a fantastic head start.
Okay, now let's start breaking down the core mechanics of this thing. It's so important to understand exactly who qualifies and, more importantly, what the absolute non-negotiable requirements are to get the benefits of this section.
The law is really precise here. Section 54 only applies to what it calls a specified oil exploration business. So what does that mean? It means any business that's involved in prospecting for, extracting, or producing mineral oils. That's it. So who can actually claim these benefits? Well, the first condition is pretty simple. It applies to any person. Doesn't have to be a company, as long as they're in this specific business. But the second condition, this one is the absolute master key. Without an agreement with the central government for this business, Section 54 is completely off the table. That agreement is the foundation for everything that follows.
All right, now for the part everybody's really interested in, the tax benefits. If you meet those conditions, what special deductions do you get access to? This is where the real power of Section 54 really shines. The Act opens the door to three really powerful types of deductions. First, and this directly answers our opening question, it lets you write off those abortive exploration costs for any areas you surrender before production starts. Second, it allows for ongoing deductions for drilling and exploration expenses even after you've struck oil. And third, it gives you something pretty unique called a depletion allowance. Think of it as a deduction for the value of the oil that's being used up, which is a concept you just don't see in standard tax law. And here's the most crucial point, and it comes straight from Section 54, subsection 4. The deduction spelled out in that government agreement can be instead of, or in lieu of, your normal tax allowances like depreciation, or they can be on top of them. In other words, the agreement has the power to completely override or add to other parts of the Income Tax Act. Its authority is absolute.
Theory is one thing, but let's see how this actually plays out with some real numbers. This is where the impact of having a Section 54 agreement becomes incredibly clear.
Okay, let's just walk through this together. Look at the column on the left. Under normal tax rules, with a revenue of 100 crores, you deduct your business expenses and depreciation, leaving you with a taxable income of 30 crores. Now, look to the right. Under a Section 54 agreement where special deductions replace depreciation, the story is completely different. That 10 crore depreciation claim is gone, sure, but it's replaced by a whopping 35 crores in special deductions. And look at the bottom line. The taxable income drops from 30 crores all the way down to just 5 crores. The tax impact is absolutely massive.
So claiming these huge deductions is one thing, but making sure your compliance is perfect is another thing entirely. Let's switch gears a bit to the practical side and talk about the critical compliance points and some common pitfalls you really need to avoid.
From a practical standpoint, here's what you absolutely have to advise your clients. Number one, that agreement with the government is everything. It needs to be guarded and maintained. 2, it's always best practice to keep separate, clean accounts just for the oil exploration business.
3. Document every single rupee of expenditure that you plan on claiming. And finally, make sure there's a clear audit trail that can back up every single number in your tax computation.
And here are some of the common traps people fall into. The biggest mistake is double dipping, trying to claim normal depreciation when the agreement's special allowances are meant to replace it. Another big one is a sloppy allocation of common overheads. You have to be able to show the expenses are directly for the exploration business. And finally, never, ever deviate from the computation method laid out in the agreement. That document isn't a guideline. For your case, it is the law.
Phew! We have covered a lot of pretty technical ground. So let's take a moment and just boil all of that down to the absolute key takeaways you need to remember. So here are the 4 most important things. 1. Section 54 isn't brand new. It carries forward the framework from the old Section 42. 2. The agreement with the central government is everything. It's the key that unlocks the door. 3. This section gives you access to really valuable and unique deductions you can't get anywhere else. And 4. Always remember the power of the agreement. Its terms can literally change how the general provisions of the Income Tax Act apply to you.
And that's our deep dive into Section 54. Thank you so much for watching. If you found this explainer useful, we'd really appreciate it if you'd like, subscribe, and share it with your colleagues.
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.